Good morning, everyone. Welcome to everyone, and we're very pleased you could join us this morning for our latest property tax webinar on the Community Infrastructure Levy, CIL. I'm Todd Arneson. I'm a property tax surveyor at E3 Consulting. I'm hoping that everyone's well this morning and finding ways to stay positive during this second lockdown. We're sorry we can't provide you with bacon rolls and coffee this morning like we usually would for one of our seminars, but needs must in these times, and we're online for this session. Our plan is to get things underway very shortly. I'll be handing over to Alan for our presentation. This should run through till about 11:50, 10 to 12, at which point I'll rejoin the conversation and we'll run through questions for Alan, and this should take us through until our allotted time slot of midday. We have had a couple of questions sent in the build up to this, but we welcome further questions via the Q&A function at the bottom of the screen. Whether that's now during the session or at the end, please do send those across. As mentioned before, though, I'll wait until the end of the session and pose these to Alan then. Just a little bit of housekeeping. We will be recording this session, so hopefully we'll be able to distribute a link to the video after the session in due course. After the session as well, it would be great if we could get any feedback from anybody. This is only our second online webinar, so we'd like to keep improving these as we move forward. There will be contact details on our last slide so that you can send this feedback across to. So at this point, I'd like to hand over to Alan. He'll introduce himself and he'll get things underway.
Good morning. Hopefully you can all hear me okay. Can be a bit surreal doing these sort of webinars because you don't get the sort of level of audience interaction, but I'll assume you can hear me unless I get any sort of indication otherwise. So we will crack on. It's the allotted time, and so we've got quite a bit to cover. So for those that don't know me, I'm the Managing Director of E3 Consulting. I've got nearly 30 years specialist experience as a property tax consultant, and prior to that was a humble quantity surveyor, so sort of sidestepped into tax some time ago. I've also recently gained my CIL accreditation, which is the CID's the Centre for Effective Dispute Resolution. And that helps with alternative dispute resolution, which is more and more part of tax reviews these days. So that's another string to my bow. As I say, we've got quite a lot to cover. Today's session is very much around the Community Infrastructure Levy, and so we will crack on. Really just wanted to sort of try and set the scene a little bit, and this sort of slide will help. You know, this is a very common occurrence. We get a lot of calls on CIL, typically sort of 10 or 12 calls a week. And the vast majority are situations where people have suddenly found out they've got a CIL liability, which they weren't expecting. This was a project we did last year, and, you know, very, as I say, you can see there, it very typically sort of represents what we see in here. Client had a out of the blue sort of demand for £17,000 from their local authority when they'd got planning permission to convert their garage into a separate flat. They had more or less given up hope of being able to get out of it, and then they stumbled on our website and then had a conversation with myself. I'm pleased to say that after a couple of weeks of going back and forth with the council and setting out the details, we were able to persuade them that the right position was very much that there should be no CIL liability, so the client demand was reduced to zero, and the client, as you can imagine, was very pleased and happy. So that is a recurring theme. I don't have a big grudge against architects, and in fact I started my education studying architecture many moons ago before I saw the light and transferred across to become a quantity surveyor and then tax consultant. So the sort of program for today is really to sort of run through, going to give you a very brief sort of background of CIL, and then sort of really sort of concentrate on the mechanics of CIL, how it works, what the rates are and how they operate, how you calculate it, and then look at some of the sort of issues we see on a recurring basis, and sort of highlight really through using sort of project case studies how we can help and how we can see how things can be improved. There's a short session which just focuses very much on London, because there's Mayoral CIL 2, which is London specific, and then we'll sort of briefly run through sort of the exemptions, reliefs, and some of the case law there. And there's more recently there's been some COVID-19 deferral measures, and also in end of August, early September, the government issued a planning white paper which also has some points. So as I say, there's a lot there to cover, and we'll then sort of summarize and finish hopefully around sort of 11:50 with a bit of time for some Q&A, and I'll welcome Todd back to that in due course. So the background really to CIL is very much based in the Barker review, done now 16 years ago. Kate Barker did this analysis where she was looking very much at how 106 operated around the country. It was seen to be very idiosyncratic. Lots of authorities were good at it and some were not so good at it, and it was just seen as being inconsistent and a bit of a problem for developers to be able to anticipate what was going on. So it was determined that there should be a sort of wholesale review and change of it. One of the first ideas that they came up with was planning gain supplement, and the government then decided, there was industry uproar, no one really liked that idea. It was supposed to be a sort of a flat rate, anywhere between 2 and 10%. I think even 15% was quoted at one point. Eventually, the Labour government, sort of Gordon Brown era, came up with the Planning Act 2008, and they sort of buried within that the Community Infrastructure Levy. We then had the sort of coalition government, and everything sort of stagnated for a little while. No one was quite clear on how that was going to work out, and then it really sort of kicked off in April 2010 when the legislation was enforced. But they've been tweaking it ever since, and it's been almost annual sort of adjustments. And after sort of after 10 years of tweaking it, a lot of commentators in the marketplace now feel that the rules sort of work much better. There is some understanding, albeit very mixed still. But now, as you'll see when I get to the white paper, that they're looking at changing it again, and some of those ideas don't quite ring through. So we'll have to sort of watch this space to see how it's going to impact over the coming years. Probably the key thing here is that there's always been exemptions for charities and social housing from the outset. Since 2014, which is when we started to get involved in CIL, so we've been advising now for 6 years or so, there's been self-build exemptions available for families doing their own sort of projects at home. This is probably the one that sort of confuses most, is everyone assumes that if everything's below 100 square meters, then it doesn't apply. And that's right for lots of situations, but if you're creating a new dwelling, then that still catches people out. And we do see that a lot of people are sort of caught by that. So those are the sort of high level sort of background. Okay, so it's supposed to be an optional charge. Obviously, the local authorities choose to adopt this. We last sort of did the numbers back in May this year, so we may be a little bit out, but it's around 180, maybe 190 local authorities throughout England and Wales. Most of those are in England. I think there's only a handful, probably 2 or 3 in Wales, which actually have adopted. And then there's a further sort of nearly 90 or so who are in the process somewhere along the sort of decision-making process, which can take up to 2 years. And that's part of the reason why they're looking at reforming it, because they feel that the cost of setup and instigation has been a bit out of balance. Initially, it was intended to replace 106. As I say, it was to sweep away with the inefficiencies of 106 and come up with a new answer. Over time, that's sort of changed, and as you can see here, 106 has not been abolished, and that they've changed the rules so that they can coexist together, sort of with 106 and CIL. But I'll come on to some important aspects of that to make sure you're not getting sort of double whammy in paying the tax liability, really. As I say, they are sort of fairly complex legislation and regulations, poorly drafted, and with the annual sort of changes, it does make it sometimes a bit difficult for people to follow and understand exactly what's going on in the background. So, you know, it's one of those things that just needs to be a bit sort of mindful of. So, you know, that's the sort of key aspects there that people need to be sort of mindful of. I think I've pretty much covered there. Oh, sorry, this probably this point here in terms of, you know, local authorities basically feel that they're not raising enough money from CIL, and this is partly why they've tried to sort of keep with CIL and 106, because they you know, the sort of statistics seem to indicate that on average they're only getting sort of 10 to 15% of the money that they feel they need to raise to provide the infrastructure for the particular location. Okay, so this slide then just sort of sets out for you the sort of difference. So we get these statutory instruments, that's what the SI stands for, and you can see here that, you know, it's changed. This is sort of statutory instrument 2010, and then they're just sequentially numbered depending on other government sort of diktats, and these are the sort of key ones. There are one or two others but they more relate to the setup of CIL rather than the operation of CIL from a taxpayer or developer, you know, the person incurring it sort of point of view. So we've kept those ones out. As you can see here, you know, there's been sort of two statutory instruments this year. The first one deals with COVID, which I'll talk about later, and the second one is also just sort of picking up some of the sort of changes around something called First Homes, which is another sort of social housing relief, again, which I'll sort of pick up later on in the talk. So hopefully that's given you a quick sort of overview of how we got to where we are. Really just want to sort of set out some of the numbers. So we've got this slide sort of sets out some of the sort of rates in London. As you can see, places like Kensington and Chelsea have quite a high level of CIL on residential. And, you know, maybe this is why local authorities aren't raising the funds that they require, because they seem to sort of treat residential one way, and the loss of residential is perhaps subject to the exemption. I think on a webinar I was on recently, I think Shropshire which was one of the sort of flagship sort of CIL counties. They were an early sort of adopter of CIL. I think they reported that something like 40% of their applications have self-build attached to them, so they're not getting money from that. Whereas you can see here things like you know, office in this sort of pale blue, or retail in this green, or student accommodation in the purple, are set at different rates. And one of the suggestions in the new sort of version going forward is maybe a uniform rate across all development. But as you can see here, the numbers, this is cost per square metre, and this is both borough CIL and mayoral CIL, so they're combined. And also sometimes within different boroughs, you sometimes get more than one rate. Just for simplicity, rather than have a slide with lots of different rates and lots of information, we've just really picked the highest rates applicable for each borough, just for illustration purposes. As I say, that CIL is applicable right across the UK, right across England and Wales. Scotland is not looking at it, albeit there has been some noise in the last year or two that they may seek to adopt it. I don't think there's any noise for Northern Ireland, or any appetite for Northern Ireland to be included. So as I say, this is just again sort of showing, and you can see here that some local authorities, you know, if you look at Reading in the centre of the slide there, you can see that they've really sort of picked fairly standard rates across all of their development options. But again, you can see that sort of Birmingham and Poole pool, I've got 2019 because they've already they adopted CIL earlier than that, and 2019 they amended their rates. So there is a process now where local authorities, once they've adopted, can sort of revisit everything and change their rates. But again, they have to go through the process to share the draft charging schedule and so on with the local development community. Okay, so looking at how we calculate CIL. So there's some key factors. The first bit really is, as you saw from the rates, it's cost per square metre. So in floor area is very important, and we use what's known as the gross internal floor area. This is sort of should be a standard definition, but we do see that a lot of people still don't use the right floor area calculation. We see a lot of assessments done using net lettable area, and net lettable tends to exclude a lot of the circulation space, whereas gross internal includes all development from the internal face of the external walls across to the next internal face of the other external wall opposite, and you ignore all internal walls otherwise. And as I say, when you tot that up, certainly on larger developments, that can add up to quite some significant differences in floor areas. So that's a key thing that we would advocate people sort of bear in mind when they look at it. The next sort of aspect is whether there's an existing building on the site, and whether that building is in what's known as qualifying use. If it is in qualifying use, then the CIL is only calculated on the net additional area. So you can offset your existing area against the end development, and you only pay on the net uplift. If it's not in qualifying use, then you get charged CIL on the full gross development area. Okay, so those are the sort of key metrics in terms of area and whether you get some sort of offset. We then sort of move on to understanding how the CIL rate applies, and that's set by the various sort of local planning authority, and they sort of publish their charging schedule typically on their website to set out what the rates are. As I said before, London has its own mayoral CIL, which is applied on top of the local London borough. Initially, that came into effect in April 2012, and that's now been dubbed mayoral CIL 1. And that changed in April 2019 to becoming mayoral CIL 2. Having established those headline rates, whether it's the local authority rate or mayoral CIL rate in London, there's a difference between the rate at which the charge schedule was published and the date at which you obtain your planning permission. And so we used to use the BCIS all-in tender price indices to uplift the sort of headline rates to the date of the planning permission. Again, that still sort of seemed to cause a lot of confusion, and people seem to struggle with it. Since last year, since the beginning of this year, January 2020, there's been a new RICS CIL specific index, and we've just had the publication of year 2 rate for that for 2021, which is the index rate of 333. And so you have to update those, and all the sort of calculations are sort of nominally fixed by the date of the planning approval, albeit for the indices we then backdate it to a certain date preceding the planning approval. So you can see very quickly how people can get confused and find it a bit sort of complicated. Hopefully I've got a noise outside the window here, so I'm hoping that's not too loud for you on the seminar, webinar, but unfortunately I can't control that. So going forward, right, what we do here is this is just really sort of illustrating what I've just sort of talked you through. So we've got an existing floor area is our green area, our purple area is our new floor area. Conveniently, it's over 100 square meters. And we're sort of assuming that it's in to see whether it's in qualifying use. The definition is you have to go back 3 years from the date upon which you get planning permission, and basically to qualify, it has to have been in qualifying use for at least 6 months, any time in that 3-year period. So it ends on the date of planning permission. And then sort of you backtrack 3 years, and as long as you've got this qualifying use, and as you can see on the slide there, there's 2 caveats to it. A, the building must exist at the date of planning permission, so you can't get in and demolish early and do things that developers like to do of preempt their sort of planning permission and start early, because that will lose you your offset. Equally, the use has to be qualifying lawful use in accordance with your planning permission. There was a case some years ago in Shropshire whereby a pub, a disused pub, was being used for storage, and they lost their qualifying use from their CIL because they weren't operating as a pub. Right, so just moving on to show you the calculations we've got here, the same figures I've just shown you. We're taking our net GIA is 125 meters squared in this situation. We're showing that the headline rate is £100, and the TPI that's adoption is 250. The TPI granted planning permission is 300. So that's basically just showing that that charge rate gets uplifted from £100 to £120, and then it's applied to our floor area. So you end up with a civil liability in that situation of £15,000. If we take exactly the same areas, but on the assumption that there's no qualifying use, i.e. it wasn't in use during that 3-year period, then the civil liability very quickly jumps from £15,000 to £60,000. So, you can see that there's quite a big impact there. Okay, just really wanted to highlight, there's lots of different issues we see quite regularly, but this is really our sort of hit list of the top 5, but we do see lots of other areas. We advise right across the piece on CIL, from simple calculations of what the rates are through to negotiating and achieving reductions, exemptions and other reliefs, through to challenging sort of surcharges and so on. So we can help on all aspects of that. Taking the first one, this is probably one of the most common we see, that people just seem to be blissfully unaware that CIL exists. Now, as I mentioned briefly before, in order to establish CIL in a particular area, the local authority goes through a process which is typically 18 months to 2 years long in order to adopt CIL. And during that time, there will be lots of consultation going on. There used to be sort of 2 or 3 versions. It's been reduced slightly so they can be a bit quicker. But essentially, there ought to be, people who are active in a particular area ought to have had opportunity to be aware of it. But we're all creatures of habit, really, and sometimes people do what they do well and what they know, but you don't know what you don't know, and that's one of the sort of key issues here. And the problem is that if CIL applies and you haven't followed the process, then non-compliance will generally lead to surcharges and/or interest and/or immediate payment. So it can be quite sort of swift and painful. And as you'll see later, the time frame by which you can challenge some of these things are quite narrow. So if you sit on paperwork and don't sort of address it promptly, you may find that you're timed out your ability to sort of challenge it or do something about it. Sadly, we see a lot of people phone us too late after the event when they're being chased for the money, rather than when they first receive something saying CIL might apply to your project. And that's, the earlier we get to look at something, the more options there are. Okay. The next one, as I've just sort of talked through the offset process, won't dwell on it too much, but as I say, the 2 key lessons here is that a building must exist on date of permission. I've got a case later on where a developer did demolish the building prior to getting their planning permission, and in that situation they do sort of struggle to they ended up with a liability that they couldn't get out of. And then I've sort of addressed the sort of building in use. So it's just looking for that offset. And there are things, if you're doing a development, if you've got say an office development which you're going to redevelop, why not look at putting a tenant in there short term? If you think it's going to take you 6 to 12 months to get your planning permission, put your funding in place and all the rest of it, then if it's empty, put a tenant in there. It doesn't really matter. They can't be an associated associated party, and they have to be paying a sort of nominal market rate. But as long as you're sort of doing something reasonable, it will give you sort of the qualifying use that may help sort of offset the floor area. The next one is probably the biggest issue we have is people commencing work before they've sorted out any of their CIL issues. And as I say, there are now sort of mandatory penalties if you start work without submitting Form 6, which is the notice to the local authority of commencement. And again, you know, if you're wanting to apply for an exemption or one of the reliefs available, or if you're wanting to challenge the numbers the local authority has given to you, all of those options are taken away the minute you start work. So you can't retrospectively address those points at all within the legislation. So commencement is a real big issue that people could find a problem with. Okay. Next one is revised or even retrospective planning permissions. You know, people sort of change their minds, people do things, you build something which isn't quite in accordance with the planning permission, and you may need to then sort of go back. Now, within the CIL regulations, you're generally okay if you do that as a minor amendment under Section 73 of the Town and Country Planning Act, then that's not an issue. So if you adjust something, then that you may have an impact depending on the start point of when your building started and what the CIL position is. And if you've got an exemption already in place, you know, Section 73 you can then sort of amend that exemption to the new area. The only downside is that, you know, if you haven't got your exemptions in place, if you've started work and failed under, you know, item 3 of this list, then you can't retrospectively recapture that. So, you know, commencement is probably the biggest important one, but then building what you've got permission for is probably the next one, or making sure that if you do vary it, you use the Section 73 wherever possible. We have seen situations where local authorities have insisted that, you know, the changes are such that they require a full new permission. And again, we've got a case later that deals with that. So I'll come on to that shortly. And then the last one really is that there's this expectation by some architects, planners, clients alike all have this sort of misapprehension that because they're doing a self-build project, then it's automatically exempt, and that's not the case. You know, in order to get the exemption, you must apply for it and go through a rigorous sort of process where there's, you know, a variety of different forms that have to be submitted to the local authority. You need to confirm that that's all done. You will then get a decision from the local authority, hopefully accepting the exemption and revising your CIL notice from whatever the number was down to nil. And then you also have to then use Form 6 to do the commencement and tell them when you're going to start. And most importantly, you have to make sure that they acknowledge they've received that. There's an awful lot of case law, and a lot of the reviews and surcharge challenges are all around people having posted their forms off to the local authority and them never having arrived. And, you know, if you haven't got proof of posting, you haven't got an email receipt or something to show that it's been received, or better still, a confirmation from them that they've got all the information they need, then you'll struggle to win your case if they are trying to apply surcharges. Okay, so just moving on to illustrate some of those key points with some case studies. This was a Victorian terrace property in the London Borough of Hackney. This was a small redevelopment of a former Victorian house, and there was two issues with this. One, the local authority was challenging the qualifying use, and two, there was a discrepancy around the floor areas. And the floor area bit was this point. Within the rules of how you measure GIA, as I mentioned earlier, you typically work from internal face of external wall. So that would typically be this sort of position. However, there is a valuation office exception to that rule. And as the valuation office is the sort of final arbiter of any queries or disputes on CIL, in most situations, apart from I'll come on to later, there are sort of pins, the planning inspectorate sort of system look at some as well. They have this sort of rule that basically says that you do not include floor area which has a floor to ceiling height of less than 1.5 meters. And so what that does is, in this particular situation, we were going from an attic to a dormer site window. So you can see here that we added some new area to the building. Now that's an interesting sort of insight. We've used that in our favour to reduce figures where you've had, you know, dormers in properties or restricted ceiling spaces, depending on whether you want to how you include that area. And in this situation, we also managed to convince the council through finding the relevant evidential proof that the building was in use and in qualifying use, and that ended up with the client in this situation saving themselves nearly £10,000. I've mentioned demolition, and, you know, again, this is really sort of the key issue of not sort of jumping the gun. This sort of qualifying use, as I've said, requires the building to be in existence. And on the left-hand side of this case, there's two cases on here, but the left-hand side in Chichester, we had a situation where a developer did preemptively demolish the building. And so there was very little we could do about that situation. And it cost them £30,000 because they lost the offsetter capability of the floor area of the existing building. That's fairly black and white within the legislation, and so there wasn't much we could do on that particular situation, albeit we did help them get reduction on some of their surcharges and interest, because the local authority was a little bit fierce in how it approached the matter, and we did get them to backtrack on some of that as well. On the other side of the screen, you can see there's a case in London Borough of Brent. This was a small redevelopment of what was a sort of small garage stroke lockup unit. London Borough of Brent decided that the building was not in use, so they applied CIL to the whole floor area of this unit, and that was, you know, £26,000. We were brought in by the building surveyors who had done the design work with the client, and again we sort of went through all the project details and talked to the client, and what we found was that it was in use and we could prove that. So again, we collated all the relevant evidence. That was sort of bank statements, and there was an informal lease agreement with someone using it as a store, but we were able to show from their bank statements that they were receiving rent throughout a sustained period within that 3 years, and therefore the qualifying use was established. So that meant that they only paid CIL on the net additional area, and that only resulted in £1,100 or so saving the client £25,000. This one deals with a very nice private house. Again, this is probably a story of woe. This was a self-build project for a couple which had a very long-standing relationship with their architect. This was their third project that they'd done over a sort of period of years, but it was the first one where CIL applied. And the situation with this one was that they were unaware of CIL. Their architect had some knowledge of CIL and filled in what was Form 1, which used to be a limit, the assumption of liability. And this was a case where the architect assumed that the self-build, because it was a self-build project, that they would get the self-build exemption. That wasn't the case. And having commenced works, the owners then had received a demand from the local planning authority in Dorset for £48,000. As you can imagine, they're a bit sort of shocked and horrored at that. We had a conversation with them. We sort of set out really what the issues were, but unfortunately we weren't able to undo that, because they had fallen into this sort of trap of commencing works, and you can't then sort of go backwards. They managed to agree by exception with the local authority some time to pay, so I think they ended up paying it in over sort of 3 instalments rather than lump sum. But they have been pursuing litigation with their architects and the architects' professional indemnity insurers to try and recover that, and that's still ongoing at the moment. So, you know, there's a big lesson there to not to stray into areas that are complex and you don't really understand. Couple of quick other sort of case studies here. Again, this is one I sort of briefly sort of hinted at before. This situation was a project in Test Valley. When the owner of the property got their planning permission for this extension to their house, CIL didn't exist. The local authority hadn't adopted, so it wasn't something they thought about. But then they decided that this area at the top here previously was just going to be empty sort of attic storage. And it was only when they sort of started to build it, they realized that they had an awful lot more space in there than they thought. And so they decided they'd make it into an ensuite bathroom and dressing area. That also required there to be windows on the front, and that's when the local authority insisted that they had a new planning permission. And the long story of all of that is it ended up bringing the whole development into the realms of CIL, because the new planning permission was A, being done retrospectively because they were nearly completed on this project, and B, the local authority had previously instigated CIL, and so the whole thing was liable to CIL. That cost them an extra £30,000, so quite a pain. Okay, so this one is a nice block of flats near the River Thames. Might be familiar to one or two people attending today, but this was a project which we only finished a couple of weeks ago, and basically this was a situation where again, the initial planning permission for this site, which was redevelopment of a commercial site into some commercial units at ground and basement level, with then sort of 9 very nice residential flats over. And, as I say, the original planning permission was pre-CIL, before London Borough of Richmond upon Thames had sort of adopted. They commenced works, and then they sort of carried on. And over the duration of the works, which sort of spanned about 5 to 6 years as they sort of developed this out, there were numerous Section 73 amendments throughout the construction period. One of the later ones, in 2019, the local authority decided that there would be CIL applicable to it. So they issued a CIL notice and demand for £16,300. Obviously, that was a bit of a shock to the client, and we sort of got involved and went back through all the detail. One of the first things we did was sort of set out a clear sort of project timeline of each permission, when it was done, when it was activated, and when work commenced, and then sort of negotiated with the London Borough of Richmond, and I'm pleased to report that we ended up getting the CIL reduced to nil, so we had a very happy client. Okay, so this is a very nice sort of major sort of basement extension to a listed property. Again, it happens to be London Borough of Richmond. We do work elsewhere, but we do deal with London Borough of Richmond and Wandsworth on quite a number of occasions. But we've got projects all around the country, from sort of Dorset through to Cheshire, through to Norfolk, and say lots of different places. But London does have quite a lot, particularly because you get this sort of double effect of the borough CIL on top of the mayoral CIL. As you can see from this slide, as I say, it was a fairly significant project. The original CIL liability was, when the client first contacted us, was at £360,000 or so. We got involved and had an assessment of that. We spotted a number of different errors in how the floor areas have been calculated for the different parts of the development. So that instantly reduced it down to about £214,000. And then we went through the process to get the client a self-build extension exemption, which we achieved. And so we saved the client, depending on how you look at it, £214,000 or £360,000, which was the start position when they first contacted us. I think this is probably one of our last ones. So again, this is just a project in Oxford City Council. In fact, this was a conversation I was having with a client who initially phoned us on a different matter. I think it was a VAT query in respect to a project they were doing in London as a developer, but the lady involved was also then doing her own extension, and through our discussion, she realised that we could help on this. The situation was that the architect was unfamiliar with the CIL rules, and they were trying to fudge it a little bit. So they were trying to sort of get within this below the 100 square metre category, when the development was actually more than that. It was about 130, maybe 140 square metres in total. I can't remember the exact figure. And essentially what they were trying to do was argue that the current attic space, which was, unboarded, unusable attic in a probably a 1950s sort of type house, was part of the existing floor space. And the first thing we asked for is, can they provide us with plan drawings? And they provided us with plan drawings for sort of ground and first, but they couldn't provide us with seconds. And after a number of conversations, they finally admitted that there weren't any drawings because it was just attic. So when you added that space of converting the attic into this new master bedroom suite, which was going to be on which, there was a proposed drawing for, it was very obvious that they were sort of trying to fudge it. So we ended up with a net area above the 100 square meters, so CIL would apply. However, we were able to sort of advise the client that we could then do a self-build extension exemption. And we did that. We got in touch with the local authority, filled in all the relevant forms, and we managed to save them £34,000. The architect also avoided the criminal record because providing incorrect, inaccurate information in CIL is a criminal offence. So getting it wrong has some quite serious sort of penalties. So we are governed by the facts. We can only sort of do what we can do. But if we get involved early enough, we can use the regulations and understand the project to find ways to improve the situation where we can. Okay, moving on to mayoral CIL in London. So what we've got here is the mayoral CIL. So the grey box on the left-hand side is our original CIL rate. So you can see that they've gone from sort of £50 going up to now £80 on band 1. And £20 to £25. So the top two have jumped quite a bit, but the bottom one has stayed relatively static. In addition to that, there are some local authorities that got a bit of a double whammy. So Enfield and Waltham Forest went from being zone 3 to what they now call band 2. So they went from £20 up to 60. So that's quite an enormous jump. And then Greenwich had the sort of benefit of going backwards. So they moved out of zone 2 and became a band 3 property. So their CIL liability, as I say, these are cost per square metre, was reduced. In addition, from April 19, the Greater London Authority also extended their CIL to have higher rates for certain uses for office, retail and hotel, as you can see on this slide, in what they call Central London and the Isle of Dogs. So the next slide shows you where they are, but these are enhanced rates over and above the standard rates for mayoral CIL. And so that's the Central London area. We're quite sort of puzzled by this sort of, because we don't seem to hear a lot of noise from developers and people sort of undertaking projects in these areas. So I don't know whether it's because maybe there's a bit of a time lag between people getting planning applications and putting funding in place, and maybe a lot of stuff that's being built now is stuff that got planning application and approval prior to April 19, and maybe it's another year or so before we start to sort of kick into people realizing that they've got these CIL liabilities. It's either that or it's been, maybe they've managed to offset it against section 106, so they see that the 106 has gone down and the CIL's gone up, and therefore they've just agreed to sort of pay it and see it as part of their development cost. The key thing I'd sort of advocate, and this is the map for Docklands, the key thing I'd advocate is we do regularly see the CIL numbers being incorrectly calculated, whether that's using the wrong rates, whether it's using the wrong uplift, or whether it's using the wrong floor areas, or a combination of all three. So, just accepting the rate as set out can be an expensive option. Okay, so just taking those changes into account, this is just an illustration of how that could impact projects. So Shard was built pre-CIL, but if it did apply, then mayoral CIL alone would have been nearly 21 million, and the borough CIL on top of that would be another 20 million, and then there's probably sort of section 106. I don't know, I wasn't involved in that particular project. I don't know to what degree their 106 payments they had to make in order to do that, but no doubt there are still some big chunky numbers. The key message we'd sort of advocate here is that, you know, because, as I mentioned at the beginning, because originally we were talking about CIL being, replacing 106, and now they're working alongside, you do need to make sure you calculate your numbers, because 106 is often agreed before work starts, and then CIL is more around the time that you start commencement and go on. So, you know, it's just making sure you understand those numbers. There have been sort of numerous consultations, and we're about to launch into another. A lot of these things sort of changed, but you know, they're quite sort of technical, so I'm not really going to dwell on those. Particularly, you've got the slides which will be available afterwards to sort of go through those. But the key thing here probably is that they softened some of the penalties, so that as long as you've got your exemption and then you fail to do your Form 6, you used to lose your exemption and whatever CIL liability then followed, whereas now you just have this mandatory surcharge, which is 20% of the CIL or £2,500, whichever is the lower. And that's probably the sort of key message from there. And then, as I mentioned, with the Section 73 amendments, you no longer, again, you used to be able to lose your relief if you tried to do something, whereas now you are allowed to sort of vary those exemptions and reliefs if you've got them. These are the CIL forms. Just conscious of time, that there's a lot of sort of changes here, and they cater for different things. Just for those that are, as I say, the numbers have changed. So the bits in green are either renumbered, renamed forms, or new forms altogether, which came in since September 19. You know, over time they do sort of change. So it's important that you use the correct form. It's important you understand what needs to go in the form, and that they're submitted in the right sort of sequence and timing, so that you comply with the regulations. Self-build deals largely with you know, people building their own home. It doesn't mean that you have to be out there with bricks in hand. You can sort of subcontract a builder to do it for you. But for housing claim, you must then occupy it on completion as your sole or main residence. If there are clawback periods here, which can be 3 years if it's a build your own house or an annex, or 7 years if it's an extension. And I'm not entirely sure why they decided that needs to be a longer period, but that's what the rules say. The other sort of thing that catches a lot of people out is this one at the bottom, whereby you have self-build extensions. You must occupy the property prior to applying and starting the works. So if you're buying a new house and then wishing to extend it, you're going to have problems if you're extending it, you know, before living in it. There are, and we've done a number of these sort of claims of social housing relief and first homes, which is the new bit. Again, this is already dealt with by sort of social housing, where it's either rented or sold at below market value, and they range from 70% to 80%. As you can see in this bit, there are sort of 5 different variants to start with of what they call qualifying developments. You've got your local housing authority, you've got your shared ownership, and then you've got your sort of private residence, and plus a Welsh variant of that. And then you've got the dwelling is let by someone other than those sort of registered landlords, but still at less than market value, at 80% or less. And then the new one is this one at the bottom, which they're calling first homes relief. And again, that has to be at below 70% or no more than 70% of market value. And there's a requirement for a Section 106 to ensure that any subsequent sale also has to be done at those values. Otherwise, there's potentially a clawback. But those are fairly new rules. They only came into effect from the 16th of November. So this is, you know, hot off the press. This is the last statutory instrument, and it's effective from the 16th of November. COVID, I guess, you know, we have to sort of mention COVID eventually in some shape or form with these things. And essentially there is a COVID deferral mechanism. It's only applicable to developers with a turnover of less than £45 million. So that could be a problem for quite a few people. Again, not sure why they chose that particular level, but that's what they've done. If you're on a project and you're required to pay CIL in this, what they call the material period, which is basically any time from July this year through to the end of July next year, then you can apply to the local authority to defer the CIL payment, and that can be deferred for up to 6 months. As you can see here, it's quite a rigorous process, but you can only do it within 14 days of the payment date. The local authority has 40 days to respond, and if they grant it, you can then shift it around and you get a revised notice and a revised payment date. The good news is if that revised payment date, so if you did this now and shifted your payment through to May next year, you could then defer it again from May next year for another 6 months. So there are some benefits, and I'm sure there'll be plenty of developers which find this very useful. If they refuse, they can't apply surcharge and interest until 7 days have passed from the refusal date. Hopefully local authorities there. But the key issue is you've got to demonstrate with some reasonable evidence that your financial difficulties are a result of COVID. As I say, there's various bits of sort of case law and how this sort of all works through. This year alone, there's been over 50 PINS cases, which is the Planning Inspectorate sort of decisions. Now, as I mentioned earlier, they're all time sensitive. So, if you want to do a review under 113, you have 28 days. If you want to challenge or appeal, there's between 28 and 60 days to do those. And if you want to send it to PINS for a surcharge review, this is sort of surcharge or demand notice, and the last one is a stop notice, then you basically have to act within 28 or 60 days, depending on which one it applies. So, as I say, it's all very problematic for, to make sure that you sort of do everything in the right time frame. There are some cases here. This one in Shropshire is one I mentioned before, where they lost the case in the pub. The Orbital Shopping Centre was to do with they sort of split their planning permission into separate phases, and they built a mezzanine and did some external works, and they managed to sort of separate it such that they didn't pay CIL. And that's led to a change in the forms, where you now have to sort of say whether you're doing a mezzanine floor as part of your scheme. The Giordano case is quite an interesting one. It's a very complex decision, but ultimately the taxpayer or the developer won their case. And then more recently, earlier this year, Oval Estates lost their case. Again, there's some technical points in there. Time doesn't really permit for me to sort of go into the detail of those, but if happy to sort of chat through with people as relevant in future. As I say, just finishing off now, we've got the sort of planning white paper came out. The sort of initial announcement is that they're looking to change CIL from being a community infrastructure levy to a consolidated infrastructure levy. I've heard some people refer to that as IL, and some are using it as CIL still, so who knows. A couple of the sort of key things about how this may or may not change. It is the proposals talk about it being set at a national rate with a certain threshold and based on outturn value. Now, you can immediately sort of see that outturn value will change very remarkably between different locations around the country and also different uses. A farm shed will have a very different outturn value to a 50-bedroom hotel in central London. And so there is a debate going on at the moment within the sort of planning and development community as to whether these changes will sort of come through as envisaged, or whether they will get rethought again, because national versus regional versus local may not work. How do you assess that threshold? Are you going to have different thresholds for different sectors or different types of property or different locations? And the big question is that one size really can't fit all. I know that local charities have all been up in arms about this, because again, the outline proposal is that there should be no exemptions and reliefs, and that everyone pays. And obviously the charity's argument is that anything that the charity has to pay on top of their current sort of things for their properties that they own will divert money from their charitable activities. I'm sure social housing is mentioned as there can be an offset. So if you have a scheme which you include social housing, that will bring down your CIL liability. And it's currently silent on self-build, so we don't know how that's going to affect sort of individuals and households. So just sort of summing up, it's very rigid procedures and regulations. We see a lot of people procrastinating and sort of sitting on things. Please don't deal with it now. A lot of these things are time sensitive. It is multidisciplinary. Feel free to sort of get in touch and we can help you with it. So, if you get it right, you can save a considerable amount of money. And if you get it wrong, it's going to cost you an awful lot of money, time and anguish. Whether the changes will be, swift, I don't know. Obviously, we've got a post-pandemic, which we haven't got to yet. And then there's a Brexit, which we don't really know the answer to. So, the challenge is what will the government's priorities be in the next sort of year or two, and whether CIL is going to be part of that. Just finishing off before we go back to sort of some question time. Tax is more under the microscope. Obviously, in the current climate, people are looking for ways to save money and improve their cash flow. Our mantra with everything is often sort of ask about what else, and make sure you've got the right advice and don't procrastinate. The earlier we get to things, the more options there are, the more we can do something about it and the more we can help. And if you get it wrong, it's going to cost you money. From our view, sound advice is always cost effective, and that brings me back to sort of questions. So I'm going to invite Todd to hopefully join us again, and we shall sort of run through any questions we might have.
Thank you, thank you, Alan. Can you see me?
Yeah.
Yeah, perfect. So we have had a number of questions. We'll answer as many as we can over the next sort of five minutes, maybe a few more. Anyone that we can't get round to, we can get back to after the session, as long as you leave your contact details. So first off, we've just had a recent one in, Alan. You mentioned that commencement often catches people out. Is there any guidance on what constitutes commencement?
Yes, I mean, it's basically governed by the Town and Country Planning Act, which off the top of my head, I think is clause 56, section 56. So it includes site clearance, demolition, everything which is sort of commencement of work. So the only thing that you can get away with, and part of the confusion here is that within section 106, you can sometimes designate things as not starting works, but you're doing some stuff under agreement. So section 106 is much more flexible, and so that's where sometimes the confusion comes. But broadly, it points you back at the Town and Country Planning Act, and that is defined. And as I say, I'm pretty sure it's section 56. I can probably sort of check that in a minute, and just sort of validate, but. It includes demolition, which is key. We see a lot of people thinking that demolition is okay. You can do some sort of site testing, trial holes, and some of that sort of site investigation is okay. But the minute you start, digging foundations and starting to change levels, other than a very cursory thing, that's considered to be sort of commencement of works.
Perfect. Another one here, I believe this one came in before the session. Can you reduce a CIL liability on the basis of site viability?
Yes, you can, but it depends on the local authority. There's sort of two aspects of this. There is, as I briefly mentioned, there's the sort of interaction between CIL and 106. So if you know your numbers and you're negotiating your 106 agreement with the local authority, you can make sure that the site viability and the economics demonstrate the correct CIL numbers. And in the past we've seen CIL not really sort of factored into that dialogue, and so you end up with a 106 that assumes a relatively modest CIL, And then as they get nearer sort of starting works or actually commencing works, they suddenly realise that their CIL numbers are much bigger than expected. And so you get this sort of double whammy effect. In addition to that, there is what's known as a discretionary relief. But in order to get that, the local authority, the LPA, Local Planning Authority, has to adopt that policy. And it's a further option. So if they've adopted CIL, they may not have the discretionary relief. They may just say, we're not doing that, and there's no discretionary reliefs. So quite a few local authorities do exactly that. They say they can't do anything. Others have adopted, and if they've adopted that, they should have a policy on their website saying, yes, we do discretionary reliefs. And there's some caveats to how that works. You have to, in order to get it, you have to make an application. It's Form 11 is the form for that one. You have to be the main freeholder or leasehold interest of 7 years or more, which is generally the case for all CIL. You have to show that there is a 106 agreement in place already, and you then have to set out the economic viability in a manner that's acceptable to the local authority. They have ability to approve who you use to set out that case, albeit there's some seem to be a bit relaxed. We've looked at a couple of projects. Unfortunately, our experience to date is that local authorities are fairly fickle about how they sort of view things, and their interpretation of what is exceptional circumstances does seem to be, in my view, rather narrow. It's problematic, but there is an option there, and the stronger you can make your case, the better. But they are trying to argue that it's, you've got to set out a very clear exceptional circumstance from the norm, and one that perhaps wasn't anticipated at the commencement of your thinking on the development.
Yeah. Okay. So moving on then, another question here. I believe you touched on this a little bit earlier in one of your slides, but someone here is just asking, what services do you offer in respect of CIL advice? And I know this is quite wide ranging. We do move to a lot of different projects. Yeah, no, absolutely. I mean, we sort of we offer a complete sort of service from sort of cradle to grave almost. So, on the one side, it can be just sort of helping people understand what the CIL regulations say and mean and how they impact your project. So we quite often do an initial review that sets out that sort of argument and how it impacts. We can then just do assessments of what the CIL liabilities are, so that people understand how the numbers work. And we've done that for very large 200 plus units sort of developments through to someone just building their own house or extension, because the start point is understanding what the numbers add up to, through to the more contentious stuff where we've challenged claims, reduced claims, negotiated different outcomes. We've also helped some architects with litigation situations, and we've worked with a couple of solicitors to help clients. If they can't get a resolution from the CIL rules, then they'll look to the law as to other options. And we had one case where we worked with a solicitor to challenge the behaviour of the local authority, because we felt that although the problem is that whilst there's lots of rules and regulations in the CIL law, there's very little that gives a time frame of how the local authority must act or by when. And we've seen in the past some situations where they, after the event, they come back sort of saying, oh, by the way, we want this money from you. And as I say, on a couple of occasions, we've sort of worked with solicitors where they've then gone back and challenged that, but under sort of local government governance type approaches, and as I say, some of those have been quite successful, but it's not really that's where we collaborate with others, but we can cover all aspects really. Okay, then I think we'll probably do one more question then, given the time, slightly overrun right now. I'm sorry about that for everyone, but final question then. If a property is vacant after purchased whilst redevelopment design/tender process is undertaken, how can a client prove occupation? Will a council tax charge be sufficient, or a utilities bill, although this won't show use but a standing charge?
Oh, that's a really sort of good one. I mean, again, there's no sort of definitive list of what is acceptable or what isn't. The rules and the guidance does sort of talk about utility bills, does talk about lease structures and lease agreements, does talk about sort of payments of, you know, council tax or sort of business rates and whatever. But it's, you know, at the end of the day, it's gathering as much evidence as you possibly can. You know, if you're going to try, you know, I mentioned briefly in the talk that you could put a tenant in there to try and get that use whilst you're seeking your planning. And if you're going to do that, then make sure it's documented. Make sure you do have a semi-formal lease, and make sure that it's, you know, signed and dated by, you know, and issued on the right dates by by your solicitors or someone, and then that way you've got some evidential proof that something was going on. Bank statements can be useful. So, you know, it's about building up a picture and demonstrating to the local authority that there's some evidence there. Ultimately, if they decide not to accept that evidence, then you're probably into your, you know, review, challenge, appeal sort of processes, and the more evidence you have, the more likelihood of success at that stage. You know, there are cases. I mean, one of the good things is, you know, some of the PINS decisions, as I mentioned, a lot of them are where people have sort of posted forms to the local authority and they've not been received. And in that situation, unless you've got some sort of proof of posting or some sort of other evidence, the default is that they just go, well, sorry, it's not been received, you're liable. But consequently, the planning inspectorate are also taking that approach with local authorities. So they're now sort of saying to local authorities, okay, well, prove to me that you submitted this CIL demand when you say you submitted it. I've got a copy of what you say, but I've got no evidence that you've issued it on any particular day. And so they are being quite fair in how they look at it, insofar as they are, you know, taking that approach and making sure that it applies equally to both parties. Thank you very much for everyone's attendance. We hope you found it very useful. The last slide is, as you might expect, our sort of caveat that we're not giving you advice. We're just sharing with you some of our thoughts and knowledge on CIL. Obviously, if you have any particular issues or particular sort of project circumstances, you know, we'd be delighted to sort of chat through more fully. So, as I say, really just like to thank you for joining us this morning. As Todd mentioned earlier, you know, we would welcome your feedback. All of our contact details are available there, and, you know, do follow us on Twitter or LinkedIn to stay up to date. So thank you very much, and I think we shall bring it to a close there. Okay, bye from me.
Bye from me. Thank you.